Hello, everyone. My name is Desi, or Advent, if you know me on any social platforms, Discord, Reddit, all the other good stuff. Today, we're going to be going over dividends. It's going to be a brief overview. I won't go into extreme detail. However, during the Q&A portion, if you do ask me anything, I will let you know what I know about that. Also, for those who are here presently, and also for those watching the replay, I recommend that you try to silence any distractions. That way you can absorb fully what we'll be going over. And then, of course, I'm sure whatever it is that's going on can be addressed later on. And with all that being said, oh, last thing. I always forget to add these. All of this presented is not financial advice. I'm not a financial advisor. This is all for educational purposes. Take with that what you will. And with all that being said, so pretty straightforward. Oh, whoops, this is awkward. I didn't change the 1 hour, 5 minutes on the bottom. Oh, no, it's correct. Anyway, quick introduction, what we're doing now for 5 minutes. We're going to be going over the modules, and then it's quick Q&A for 30 minutes. Keep it a cap at that. And then, yeah, cool. So with all that being said, actually, before I do that, sorry, bear with me. Just want to bring up the chat so I can see what you guys say at the same time. Cool, you guys can see my screen?
Yes.
Perfect. All right, so what are dividends? Dividends are the distribution of a company's earnings to its shareholders and is determined by the company's board of directors. Dividends are often distributed quarterly and may be paid out as cash or in the form of reinvestment in additional stock, which is like the dividend reinvestment program, which I'll touch up a little later on. Pretty straightforward. After a company mentions a dividend payout, they're gonna, just by you owning that stock, they're gonna pay you in cash. So let's say, for example, if you own Apple stock, every 3 months, they're gonna give you 92 cents per share that you own, at least at the current value, last I checked. And also, whatever questions you may have, you can put them in the chat. In the Q&A, you can come off mute and then just ask freely, but just to keep the flow of things. And this making sense so far? Before I move on, type yes in the chat, give me a thumbs up, whatever works. Cool. So dividend dates, super important to know. Announcement date, that's pretty much just when the company puts out the announcement that, hey, we're gonna announce that we've announced a dividend, that we're gonna give it out, which is gonna be the declaration or ex-dividend date. And this is usually approved by the shareholders. So, whoever are usually the highest shareholders in the company, they decide if the dividend is going to be paid out or not. After that's done, now we have the ex-dividend date, which is the date in which the eligibility expires to receive the dividend payout. You must own the stock at least 1 day prior to the ex-dividend date. So, for example, if Apple announces an ex-dividend date of December 15, you need to own that stock on December 14th or prior. If you own it on the date of or afterwards, they will not give you the payout on the payout date. So pretty straightforward. The payment date, it's the date that the company is going to pay you out for owning the shares by that time. So for example, let's say if they announce the ex-dividend date on the 15th of December, the payout date might be like January 15, like a month or so later. Cool. Making sense so far?
Yes.
Cool. And again, what you can do that some people do, I don't really do it because, my dividend stocks are long-term. You can sell your stock after you get paid out and, you'll still get it out. So some terms that you guys got to know: the dividend yield, essentially the dividend per share in regards to the dividend or the price as a percentage of the company share price, or stock price. So for example, let's just say for Apple, at its current price, its current yield is 0.65% of the current stock price, which will give you 92 cents annually per share. So let's say they pay you, Apple pays quarterly, so they pay you 4 times a year, or they do the ex-dividend 4 times a year. So 0.92 divided by 4, they give you 23 cents per share per quarter. But yearly, you'll get 92 cents per share. And the expense ratio, the expense ratio is more so like if you're investing into funds like ETFs, like SPY, SCHD, VOO, VTI, stuff like that. Now, expense ratio pretty much measures how much of a fund's assets are used for administrative and other operating expenses. For investors, the expense ratio is deducted from the fund's gross return and paid to the fund manager. Operating expenses reduces the fund's assets, thereby reducing the return to the investors. So for example, let's just say if the yield, or you're getting paid 10% of the current stock price, but the expense ratio is 1%, you're gonna get the difference, which will be 9%. Now, one thing as an investor that you need to determine is the expense ratio when you're getting into specific stocks. Now, some people may think like, oh, this stock has a 12% yield. However, the expense ratio might be 2%. So you're really only getting 10%. And something to note, passive index funds usually have a lower expense ratio than actively managed ones. Cool. So growth stocks, it's pretty straightforward. Growth stocks are companies that are expected to grow and to grow sales and earnings at a faster rate than the market average. And growth stocks typically don't pay dividends or pay an extremely low amount. For example, Apple, I would consider more of a growth stock because it grows, as you can see, we'll have like 5-10% fluctuations during the year, but they only pay 0.65%. So Apple is kind of like a best of both worlds. However, it's more of a growth stock. You'll make more of your money from, you'll make more of your money based on the stock itself growing as opposed to getting a dividend payout. For example, another one that I can use that's not a growth stock would be an ETF fund, QYLD. They pay, I think it's about 10 to 15%. I haven't checked in a while, but they pay you more in dividends. However, the growth of the stock is basically not, like, almost non-existent. And I'll give you some examples later on. And value stocks, essentially, a value stock essentially refers to shares of a company that appear to trade at a lower price relative to its fundamentals, such as dividends, earnings, or sales, which make it appealing to value investors. Common characteristics of value stocks include high dividend yield, low PB ratios, and low PE ratios. In simple terms, a value stock I will consider like Coca-Cola, maybe Coca-Cola and some others that, the stock doesn't grow. Like, Coca-Cola might not get a big like jump in the year, like 10-15% growth, but the dividend will be like 3-4%, stuff like that, as opposed to Apple, that's 0.65. But they grow a lot more during the year. And let me know if that makes sense. I can try to clear it up if need be.
Makes sense.
Cool. Moving forward. So qualified dividends versus ordinary dividends. A qualified dividend is essentially just an ordinary dividend that meets the criteria to be taxed at a lower capital gains tax rate. For example, once you've owned the stock for more than, on average, depending which ones, it really depends on which ones you're getting into, but for the most part, if you own a stock 61 days or more prior to the ex-dividend date, it'll be a qualified dividend. So the tax rate that it gets hit with is going to be much lower than an ordinary dividend. And an ordinary dividend was pretty straightforward. It's just like let's say if Apple's going to pay me $1 this quarter, I might get taxed 20% on that dividend, as opposed to if I had it 61 days or more prior, they might only tax me 10% on that dividend. Cool. So going a little further, for qualified dividends, dividends are separated into two classes by the IRS. A dividend is an ordinary dividend if you held the stock for less than 61 days in the 121-day period that began 60 days before the ex-dividend date. And like we mentioned before, the ex-dividend date is 1 business day before a dividend is declared. If you purchase it on or before that date and hold it for 61 days or more before the dividend, it is a qualified dividend, which qualifies it for a lower capital gains rate or tax rate. And then here's just some quick little examples of a portfolio. So here we have the total assets, more or less how much everything is valued at in total, the current profit and loss by everything. This is the dividend market, essentially how much you would be getting paid based on all your investments. So in this specific portfolio, you're getting an 8.15% return on your overall value. So just by owning these stocks, you're getting 363.84 a year just by owning them. And of course, that can fluctuate if a stock reduces or increases their dividend payout. Then of course here, these are just the months. On the bottom left, how much you're going to be paid out and when. The allocation. So this portfolio is mainly ETFs, financials, high tech, stuff like that. And then on the right side, when they do pay you out, this is the amount that they paid out per share. So in this case, AT&T, they paid 52 cents per share times 150 shares that you had at that moment. They give you $78 in your account, and they'll just literally deposit it into your account as cash. You can withdraw it. You can use it to buy more stock, buy something else, literally do whatever you want with it. Making sense before I continue on?
Would you have to be in like a lot of shares to get like 363? Is that like a lot of shares?
Well, this value here is based on, let's say, a 4,500 value portfolio. And again, this is just by diversifying, because you can put your account, let's say in JEPI, and they give you about, I think the current yield is, let me double check for you guys and I'll tell you. The current yield for JEPI is, one sec, 11.26%. So if I just went all in on JEPI, then I would be getting, based on this account size, 4,500, I'll be getting roughly $450 a year just by owning that one stock. However, it's usually recommended that you diversify, because, if one sector, like if I'm all in, let's say Intel, and then Intel dumps out, then now my whole portfolio might be down 10% and I'm only getting 3% based on Intel. So it's usually recommended you have like a balance in your portfolio. So like if one is not doing well, the others will make up for it. And of course, depending which stocks you choose, you may, it might depend where you are in your, your age group, what you want from that portfolio, things like that. Did that make sense?
Yeah, and the $40 loss, it's not really $40 loss, right? Because that's getting made up when they pay you $363 a year, right?
Well, yeah, not only that, but the profit loss, that's just the open profit and loss that I haven't, if I sell it, if I sell everything, I would take a $39 loss compared to the initial amount that I put into this account. However, this is a long-term account, so I don't care whatever I'm currently down or up. If I MC, this one right here is one of my portfolios that I'll share with you. Well, it's right here anyway. So, and I'll go over it a little later on. And also really quickly, Mariah, you asked like if that's a lot and stuff like that. Right here for this payout in February, I only had 100 shares, and then I increased it to 150 by this payout. So that's why they gave me $26 more. So of course, the more you put in, the more you're gonna get out. But of course, you want to have a balance with your portfolio.
Got it. Thank you.
Welcome. MC asked, to get paid dividend, you should be holding the stock for a certain amount of time apart from owning it prior to a day or before the ex-dividend date, right? What is that time period? So pretty straightforward. To get paid the dividend, in simple terms, you need to hold it 1 day or more prior to the ex-dividend date. So let's say today is December 18. If Apple says the ex-dividend date is on the 20th, which will be Tuesday, you have to buy tomorrow. If you bought it Tuesday, you're not going to get paid out when they give you the payout. But if you own it, if you bought it Tuesday, you lost out on the payout from the current ex-dividend date, but you'll qualify for the next one once they announce that because you have the stock now. Making sense?
No, what I was, earlier in some other discussions, I was told that, yes, one condition is that you need to have owned the stock before the ex-dividend date, 1 day or before, right? In addition to that, you need to hold it for a certain period, like 15 days or something. I can't recall actually, but I was told that there is a certain period of time that you need to hold that stock to get the dividend paid. That's what I was told. That's why I was asking the question.
Oh, you mean in the sense of like if I bought it tomorrow for the ex-dividend date, and then once it passes, I'm just going to sell out just to get the payout, right?
Right.
Yeah, you can do that, but it's usually not recommended because you're just going to break even. Because usually whatever, let's say if Apple's at 100 and the dividend payout is $1, if I sell the next day, the stock is going to drop in accordance to the dividend payout, at least like 98% of the time.
Yeah,
So,
that was my follow-up question. So yeah, okay, so hopefully you can cover that. But that, yeah, I know that part. Once the dividend is paid, the stock price drops. I don't know how much, what is the ratio or the formula, I don't know. But that part I know. But the other thing I was trying to clarify is that, for example, ex-dividend date is 15th and you bought your stock on 14th or prior, but you also need to hold that stock. You cannot sell immediately next day of the dividend date. I was told that you have to hold it for 10 days. I don't know the time period, but there is a certain period you need to have it in your account before you sell it out.
yes.
I know what you're saying, that the price drops and then, yeah, you won't make it. But that's what I was trying to clarify, actually. So if you are aware of it, that's fine. If not, then I'll try to figure it out.
I can't remember the exact time, but I'm gonna make a note and then I'll get back to that.
Yeah, I was told in one of the previous webinars, or somebody just mentioned that you still need to hold it for a certain amount of time. That's why I don't recall how much period is that. That's why I asked the question. So
Great question. I wrote it down, so I'm gonna look that up.
Sure, no issues.
Yeah. You're in my Discord, correct? Or another one?
Yes. Yeah, I'm on Cerulean Academy. That Discord. Yes.
Oh, perfect. Cool. Yeah, just send me a private message. That way I know to respond to you.
Sure.
Or tell the whole group, either one.
Yeah, I can post that
Perfect.
same question
I
there. Yeah,
appreciate
no worries.
So yeah, I'll figure that out and then I'll get back to everybody. And I'll probably just put it in the description in the YouTube as well.
Okay, thank you.
Of course. Cool. So some last things, really quickly, that some investors may want to know when you're investing in dividend stocks. High yield traps are very, very important, because they're, you may see some stocks. You're like, oh, Desi, look, this thing pays 18-20%. This is amazing. And and it only costs like $10. But for stocks like that, it's not sustainable to pay those high amounts. So more than likely, you're going to lose on the value of the stock. So for example, I can get in at $10, but the stock might dump out 10, 20, 30%. So now I got to wait a whole year and a half to even go back to break even from the payouts. And that's assuming that that company still keeps the same 20% payout in the dividends, which is not sustainable. So something to consider when you're looking for specific stocks. And also, I'll give you an example for me. There's like the YLDs, like QYLD, RYLD, and I think like XYLD. They pay out high dividends. However, the stock itself is like, if you bought QYLD at the beginning of the year, or like late last year, they were like at $21, $22, and they paid out like 12, 15%. But the stock is down like 20, 30% since then. So you're not even at break even, and you got to wait at least 2 more years. And you better hope that the stock either moves sideways or goes back up to where you bought it before you even get back all your money from your original cost basis. Let me know if that makes sense before I continue.
Yeah, it does.
Cool. And then another thing, one thing that you can do, MC, is covered calls, which is something that I do on my long terms. So I'll quickly go over it. I have it in my options guide that I'll just put in the description in the YouTube video. But covered calls is an option strategy where you can sell a call and use your shares as collateral to collect extra premium. So for example, if I have 100 shares of Apple, I can sell a call that's worth, let's say, 200, and I can collect the 200. And if it expires worthless on the expiration date, then I collect the full $200 from that contract. Or if the contract loses value and it's at 150, I can buy it back and collect the $50 and making extra money as I hold my long-term stock. I won't go too deep into that, because that's in the guide, which I'll share with you guys later. And also, MC, there's the dividend capture method as well. So some people use a dividend capture method. So let's say if I have 100 stocks, 100 shares, and then the ex-dividend date is tomorrow or whatever it may be, I would sell a call. And then after the ex-dividend date happens, I will buy back that call and then just collect that extra premium. Like, for example, for UWMC, I think it was last week or 2 weeks ago when they announced their dividend date, I sold the call at the money, and then I bought it back for about 90%. So I made 90% on all those calls that I bought or that I sold to make extra money on top of getting paid out the dividend. But of course, as always, learn the strategy, know how it works before you try it. You can try it on a paper account. That way you kind of figure out how it works, because selling premium or selling options or going short options is a whole nother ballgame. Putting that out there. Cool. Lastly, income over growth or vice versa. So again, it really depends the type of investor or long-term investor for that specific portfolio you want. Like, what do you want? For example, people who want dividend stocks to be more of an income may be looking at stocks like JEPI, like covered call ETFs, because their payout is pretty high. Like for JEPI or JEPI, they'll pay you 11, 12% based on whatever you put into it. So if you put, let's say, $10,000 into it, you'll be getting $1,000 a year, which will be roughly, let's do some quick math. $1,000 divided by 12, you'll make $83 a month just by owning that stock. So you can withdraw that, I don't know, pay your phone bill, whatever it is you want to use it for, you can use that. It's usually recommended from what I've read that younger, for income, that's usually something that older, like, people who are retired, because, you can put it in your retirement account where you don't necessarily get taxed because it's a retirement account, and you can take money out without getting penalized. However, you can put it into a regular account, like a taxable account or a regular brokerage, and just get paid out monthly by it if you choose to. However, as a young investor, people usually recommend that you look for growth. For example, if I can get Apple today at $100, but maybe when I retire in 30 years, Apple might be worth $200, as well as getting those dividend payouts that Apple does. So again, it really depends on your strategy for that portfolio. For me, I kind of do a balance of both. I have, well, for my taxable account, it's like 30% income, 70% growth. And then my long-term, like my Roth retirement account, I have about like 15%, if that, like income, and then 75 or 85% like growth stocks and value stocks that grow over time, but also give me a good amount of yield, for the dividend payout, stuff like that. Like for my long-term Roth, I have about 4 to 6% yield for that account. But for the one that I just showed you, more of a smaller one that I have, it's a little more aggressive, which with about 8 to about 10% growth yearly. Cool. And yeah, with that being said, that's pretty much it for now. I probably in the future, I'll make a more in-depth guide for dividends, because it's kind of just like a brief overview. Any questions you guys may have, definitely let me know. We'll just do this as the Q&A period and go from there. You can come off mute, type in the chat, whatever you have. And
Hi, Evan, if you can hear me. You talked about the expense ratio. Would I be able to find that like on a website like FinViz when I'm looking up a company? Should I be able to find that somewhere?
yes, great question. So for expense ratios, depending what broker you use, some of them may have it there. Like for example, if you use Webull, and let's say you just click on any stock. On the top right, there's going to be like the high, low, and volume. To the right of that, it's going to have a little arrow right next to it. You can click on that, and it'll say like if there is an expense ratio and how much it is, stuff like that. Usually that'll show up on ETFs, because ETFs have those. Another thing is, so the platform that I just showed you guys now on the presentation is The Rich. That's pretty much just to track it. There are a lot better ones that I use here and there that I glance at it, but I kind of just use that because whoever's seen my TradingView training, I love aesthetics and I love the way that platform looks. It's free to use. I wouldn't connect anything to it. I literally just input everything manually. The best dividend tracking app that I've ever used is, I think, Simply Safe Dividends. They don't have an app. It's more of just a website, but that's like literally the best one I've ever used. I love it. I love it. I love it. If you can find somebody that you trust, you can just split the cost. I think it was like $100-120 a year. Me and my friend split it. It gives you all the stocks. It literally tells you how long they've been paying it, how long they've been around. Literally gives you like everything. If they're safe, if they're traps, literally all the details you need to know on the stock. Simply Safe Dividends. There are some other ones, but as of now, Simply Save Dividends, and then the Rich, the one that I use. I think there was another one that I used to use. I think it's just My Dividends. But they were like missing stocks, which was weird. So I stopped using that. So now I just use my Simply Save Dividends and the Rich. Cool. And yeah, I think FinViz should have it as well. Let me double check because I never really went on FinViz to check for that information. And while I'm looking this up, you guys can ask me more questions.
Yeah, I wanted to ask you, how much do you add on to your portfolio, you would say? Do you like keep like dollar cost averaging into it?
I would say so. It really depends on how much you want to put in. Like for me, for example, like from my day trading, regardless if I'm averaging up or if I'm averaging down or like dollar cost averaging, I take 10% of whatever I make in profit and I put it into my long-term positions. And I split it up in relation to whatever I want to put in. So for example, on my long-term, I haven't added any more to my like taxable account. I'm trying to put as much as I can because in a retirement account like a Roth, they only give you, I think, 6,500 max contribution towards the year. So I'm trying to, since I started that recently, I'm trying to max it out as fast as I can before the year's done. And then I'll start putting more in next year. So with that being said, it's really in relation to what you want. Like if you have, let's say, $5,000 that you want to put into the stock market, just find out what stocks you want to put into, and then just divide it evenly. So let's say if I want to put 1,000 into Coca-Cola, 1,000 into Apple, 1,000 into SCHD, Devo, whatever it may be. What I would do if I have $5,000 every month, because some people are like, oh, I'll just put all of it in right now. I don't really like doing that. I would do, all right, I'll do either 500 a month and just divide it into all those stocks, or I'll do 1,000 a month and divide it into all those stocks until I hit the full 5,000 that I want to put into it. You can do that, which some people do. I did that in the past. However, since I trade full time now, and based on what I make from trading, coaching, and all my other ventures, I take a percentage not only from what I make trading, but also my monthly income, and I put it into my retirement account. Since I don't work a conventional job, I'm basically managing my own 401k, to keep it simply. However, if you do work at a job and they have a 401k, you'll probably see it in your paycheck, like they take money out and just automatically put it into that account, which is essentially what this is. Let me know if that makes sense.
Yeah, it did.
Cool. Questions, if anybody has it.
So you would say the best platform to buy dividends on is Webull?
You can kind of do it on any platform that you choose. For me, I have some on Webull. I have some on Thinkorswim. Well, I only use those two apps. So I have my retirement on Thinkorswim or TD. For Webull, I have some in a taxable account, like a regular account. And then on my Thinkorswim, I have both a regular taxable account that I have some stocks in there that pay me dividends, and I also have my retirement account in there as well that I put money into. However, if you just want to have something somewhere like that's just easy to follow, you can do it wherever you want. But yeah, Webull, Thinkorswim, TD Ameritrade, Fidelity, Schwab, literally wherever you guys want, you can do that. Those are the ones that I use: Webull and Thinkorswim or TD. Ryan, I know you have questions. I know you're waiting to ask.
I'm good.
Cool. So yeah, any other questions you guys may have?
Oh, did you record this? Because I came on like super late.
Yes, this is being recorded. So it'll be on the YouTube probably like in about an hour or so, or an hour or two. You'll see it up there. All righty. Any last questions?
I'm good, thank you.
Sweet. All righty. Well, you guys are very, very welcome. I appreciate you all for coming out. MC, definitely DM me when you can, and I will look that up for you, and I'll share with everybody else in the comments, or in the group, and then also in the description in YouTube, and we'll go from there. Oh, perfect, perfect, perfect. I'll check it out in a bit. Well, again, I appreciate all of you coming out. I will talk to you guys on the internet, and I will put this up later. Make a beautiful night. Peace.
Thanks.
Thank you. Good night.